Eli Lilly and Company, NYSE experienced a downgrade from Wall Street Zen, shifting from a buy to a hold rating, reflecting a cautious stance from analysts amidst mixed signals from other brokerage firms. HSBC Global Res previously downgraded the stock from a strong buy to a moderate sell, while UBS Group slightly reduced its target price but maintained a buy rating. Despite these downgrades, the stock has a consensus rating of moderate buy, with an average price target of $1,011.61, suggesting that while some skepticism exists, overall sentiment remains cautiously optimistic. Financially, Eli Lilly reported a significant 45.2% increase in quarterly revenue compared to the previous year, though its earnings per share, EPS, of $3.34 fell short of analysts' expectations of $4.64. The company's robust revenue growth, however, was overshadowed by a substantial miss on EPS, which could indicate higher operational costs or other financial challenges. With a market capitalization of $735.61 billion and a P/E ratio of 63.16, the company remains a significant player in the pharmaceutical industry. Though the high debt-to-equity ratio of 2.18 warrants attention, the mixed analyst ratings and financial performance highlight the need for investors to closely monitor Eli Lilly's strategic moves and market conditions.
AST SpaceMobile Nasdaq, ASTS, has captured investor attention with its ambitious plan to build a satellite-based broadband cellular network. The company is in the early stages of deploying this network, targeting major markets like the United States, Europe, and Japan. Notably, AST SpaceMobile has partnerships with telecom giants such as AT&T and Verizon, which plan to market the satellite service as an add-on to their existing offerings. This innovative approach allows customers to access phone services globally using their current cell phones, potentially driving significant growth as the network expands. However, prospective investors should consider the challenges AST SpaceMobile faces. Launching satellites is a costly and complex endeavor, with the company relying on third parties for successful deployment. Moreover, despite its promising prospects, AST SpaceMobile has yet to turn a profit. The stock's meteoric rise, over 400% in the past year and nearly 600% over 3 years, suggests that much of the anticipated success may already be reflected in the current share price. This rapid appreciation raises concerns about overvaluation, especially given the considerable capital investments required to expand its satellite network. Consequently, AST SpaceMobile remains a high-risk investment, potentially suitable only for those with a long-term horizon and a tolerance for volatility.
The semiconductor industry is witnessing substantial growth due to the increasing adoption of artificial intelligence, with companies like Micron Technology and ARM Holdings playing pivotal roles. Micron Technology has experienced a notable 37% increase in revenue year-over-year, driven by a 50% quarterly growth in its high-bandwidth memory products. This growth is supported by a projected $1 trillion annual data center spending by 2029, positioning Micron as a potentially lucrative long-term investment. Analysts have set a consensus target price of $126.75 for Micron, with a moderate buy recommendation from 24 ratings firms, reflecting strong confidence in its potential performance. The company's recent earnings report exceeded expectations, with earnings per share of $1.91 against a forecasted $1.57, and revenue of $9.30 billion, surpassing the expected $8.83 billion. Micron's strong financial health, evidenced by a current ratio of 3.13 and a low debt-to-equity ratio of 0.28, coupled with a recent dividend announcement, further enhances its appeal to investors. Conversely, ARM Holdings, renowned for its CPU design and licensing, reported a 34% revenue growth year-over-year, fueled by its widespread adoption in smartphones and increased presence in data centers. Despite its promising growth prospects and significant role in powering cloud services for major tech companies, ARM's stock is currently trading at a high valuation of 88 times this year's earnings estimate, suggesting a need for stabilization before it becomes a more attractive investment. While both Micron and ARM are well positioned to benefit from the AI boom, Micron's more favorable growth-to-value ratio makes it a more compelling choice for investors seeking market-beating returns.
Bangladesh has made a substantial payment of $384 million to Adani Power in June, significantly reducing its outstanding dues under a power supply agreement with the Indian company. This payment is part of a larger $437 million commitment for the month, aimed at clearing Bangladesh's admitted claims up to March 31st. The payment reduces Adani's claimed dues to around $500 million. The financial strain on Bangladesh, exacerbated by rising import costs due to the Russia-Ukraine conflict and domestic political changes, had previously led to reduced power supply from Adani. However, full supplies resumed in March 2025 as Bangladesh began addressing its payment obligations. The 2017 power supply agreement, which involved Adani Power's Gada power plant supplying electricity to Bangladesh, has been under scrutiny following the political shift in Bangladesh. The interim government, led by Mohammed Yunus, has called for a review of the power purchase agreement, citing concerns over its transparency. In light of Bangladesh's financial struggles, which include a decline in foreign currency reserves and increased power shortages, the government has sought additional financial support from the IMF. Adani Power has agreed to waive a late payment surcharge for the first half of the year, contingent on Bangladesh maintaining its payment commitments, highlighting ongoing negotiations over coal costs and plant capacity calculations.
Pony AI, a key player in the autonomous vehicle sector, is gaining traction with its expanding robotaxi services across China, showcasing significant revenue growth in its latest quarterly report. The company, which operates both in the U.S. and China, is benefiting from a diversified revenue model and recent cost reductions in its autonomous vehicle systems. These developments have bolstered its investment appeal, positioning Pony AI as a strong contender in the burgeoning autonomous vehicle market. Notably, the company has received successful regulatory approvals, marking a pivotal step towards broader service deployment and monetization. The potential acquisition interest from industry heavyweights like Travis Kalanick, co-founder of Uber, further enhances market sentiment around Pony AI, although the company remains confident in its standalone growth trajectory. This news comes amid a backdrop of a rallying U.S. stock market, prompting investors to scrutinize the sustainability of current valuations. Pony AI's robust performance and strategic advancements, however, provide a compelling case for continued investment, underscoring its potential for long-term growth in the autonomous vehicle industry.
Fintech company Slice has launched a new UPI credit card and opened a UPI-powered bank branch in Bengaluru, marking a significant expansion following its merger with Northeast Small Finance Bank. The Slice UPI credit card, which incurs no joining or annual charges, allows users to make transactions via QR codes and UPI payments, offering up to 3% cashback on all spends. A notable feature, Slice in 3, enables customers to convert purchases into 3 interest-free installments, enhancing consumer flexibility. The newly inaugurated branch in Koramangala integrates UPI services across various customer interfaces, including self-service kiosks and a UPI-enabled ATM, further solidifying Slice's commitment to merging credit with UPI functionalities. This strategic move positions Slice as a formidable player in the fintech space, differentiating itself by operating its banking infrastructure and credit underwriting, unlike many fintech firms that depend on third-party banks. The company, which has raised nearly $400 million in funding, aims to democratize credit access beyond traditional ecosystems, and is eyeing a public listing within the next 3 to 4 years. Slice's profitability milestone and robust backing from major investors such as Tiger Global and Insight Partners underscore its potential for sustained growth and influence in the digital banking sector.
Financial news summary. Asterisk. In a strategic move for long-term investors, healthcare giants Abbott Laboratories and AbbVie are highlighted as promising stocks to buy and hold indefinitely. Abbott Laboratories, with a robust market capitalization of $240 billion, offers a diversified portfolio across medical devices, diagnostics, nutritional products, and established pharmaceuticals. The company anticipates an 8% revenue growth in 2025 and continues to innovate with recent developments like the Volt PFA system in Europe. Abbott's consistent financial performance is further underscored by its status as a dividend king, having increased its dividend for 53 consecutive years, making it an attractive option for income-focused investors. Similarly, ABBV, a spin-off from Abbott in 2013, has demonstrated remarkable resilience, particularly in the face of losing U.S. exclusivity for its blockbuster drug, Humira. With a market cap of approximately $328 billion, ABBV has effectively pivoted by bolstering its pipeline through strategic acquisitions and internal R&D, positioning its successors, Rinvoq and Skyrizi, to achieve combined sales of $31 billion by 2027. AbbVie's financial appeal is enhanced by its substantial dividend yield of 3.51% and a history of annual dividend increases, making it a compelling choice for value investors. Both companies exemplify stability and growth potential in the healthcare sector, offering investors a chance to capitalize on enduring demand for healthcare innovations.
Dogecoin, Doge, is anticipated to see potential gains over the next 12 months due to three key macroeconomic trends. Firstly, central banks, including the Federal Reserve and the European Central Bank, are signaling potential interest rate cuts, which could push investors towards riskier assets like cryptocurrencies. Lower interest rates make borrowing cheaper, encouraging investment in high-risk, high-reward assets. As investors move along the risk curve from blue-chip stocks to growth stocks and eventually to cryptocurrencies, Dogecoin, despite lacking fundamental value, could benefit from increased liquidity and market sentiment shifts. Secondly, global liquidity is on the rise, as evidenced by the record-setting M2 money supply, which measures cash and cash equivalents. The U.S. has reversed its quantitative tightening, and China's central bank has injected significant liquidity into its financial system. This increase in global liquidity often finds its way into speculative assets, including cryptocurrencies like Dogecoin, which are culturally recognizable and capable of dramatic price movements. As liquidity continues to expand, Dogecoin could see renewed interest and investment. Lastly, Bitcoin's performance often sets the stage for Dogecoin's price movements due to their historical correlation. Bitcoin is nearing its all-time high, and its momentum could spark a speculative rotation into Dogecoin. While investing in a meme coin like Dogecoin might seem questionable, the broader macroeconomic conditions suggest that even assets without intrinsic value can experience price surges. Investors should be aware of these trends and consider the implications for both speculative and more stable investments like Bitcoin.
Interactive Brokers Group, IBKR, recently completed a 4-for-1 stock split, reducing its share price from approximately $208 to $52. This move aims to make its shares more accessible to retail investors by lowering the nominal per-share price. Stock splits, a common financial maneuver, divide each existing share into multiple new shares, maintaining the same overall value of a shareholder's investment while increasing the total number of shares. This strategy can attract a broader investor base, especially those with limited funds, by making it easier to purchase whole shares and diversify portfolios. The trend of stock splits has been notable in recent years, with major companies like Tesla, Apple, and Amazon executing splits to capitalize on high share prices and maintain investor interest. However, the rise of fractional share trading has somewhat diminished the necessity of splits, allowing investors to buy portions of shares for minimal amounts. Despite this, companies with high nominal share prices, such as Interactive Brokers, continue to pursue splits to enhance liquidity and appeal to a wider audience. Looking ahead, companies with high share prices, a history of splits, and strong consumer-facing brands might consider similar actions to optimize their market positioning.
Bessemer Group Inc. has increased its stake in Palo Alto Networks, Inc., NASDAQ, PAN-W, by 4.3% during the first quarter. As per its latest SEC filing, the fund now holds 25,767 shares valued at approximately $4.4 million. This move is part of a broader trend where several institutional investors are either increasing their holdings or initiating new positions in the cybersecurity firm. Notably, Remen Capital Advisory Group and Whittier Trust Company of Nevada, Inc. significantly boosted their stakes in the company during the fourth quarter of the previous year. Institutional ownership of Palo Alto Networks stock is high, with hedge funds and other institutional investors holding 79.82% of the shares. Palo Alto Networks has been receiving attention from analysts, with a consensus rating of moderate buy and an average target price of $208. The company's recent earnings report revealed a quarterly revenue of $2.29 billion, slightly surpassing analysts' estimates, and a 15.3% increase from the previous year. The firm reported earnings per share, EPS, of 80 cents, exceeding expectations by 3 cents. The positive financial performance, coupled with strategic investments from institutional players, suggests a strong market position for Palo Alto Networks in the cybersecurity sector. However, insider selling activity, including significant stock sales by CEO Nikesh Arora and EVP Lee Cleric, may raise questions about the company's future stock performance. Despite the insider sales, Palo Alto Networks stock has shown resilience, with a trading price of $200.57, reflecting positive market sentiment and confidence in the company's long-term growth prospects.